Hello everyone, welcome to Dikshan classes. Today I am going to teach about the revenue recognition realization concept. It is a concept when the sales are proceeded till the amount is not received, it is not considered as the revenue recognition concept. Let us understand with the examples. For example, a manufacturer who produce goods on the receipt of order. When an order is received from B, A start the process of production and deliver the goods to B when the production is complete. B makes the payment on the receipt of the goods. In this example, sale is presumed to have been made not at the time of when the goods are delivered to B. A second aspect of the realization concept is that the amount recognized as a revenue, as the amount is reasonably certain to be realized. Next is when is revenue recognized? Revenue from a sales transaction. When the seller of a goods had transferred to the buyer property, ownership in goods for a price and the buyer become legally liable to pay. It means that when the seller has transferred goods to the buyer of the property in goods for the price and the buyer become legally liable to pay. Revenue from services when the services has been rendered. Next is historical cost concept. It is a concept closely relevant with the going concern concept. Under this concept, the transactions are recorded only in terms of the cost rather than the market value. Fixed assets are only entered in terms of the purchase price with an original cost the asset at the moment of price. It means that the transactions are recorded only at a cost rather than the market value. Fixed cost are fixed assets are entered in terms of the purchase price when the original cost of the assets at the moment of purchase. The depreciation is deducted from the original value of the assets when the initial purchase price of the assets will highlight the book value of the assets at the end of the accounting period. The marketing value of assets should be not taken into consideration. Why? Next, the market value can be bifurcated into two categories: realizable value and replacement value. Realizable value is the value of the assets at the moment of the sale of the realizations. Next is replacement value. Replacement value is another value which is considered as a moment of replacing the old assets with the new one. These two cannot be same at a single point of time, and the wear and tear of the assets will play a pivotal role in fixing the realization value, which has a democratization over the latter. Next is historical cost. All the transactions are recorded at their original price cost. All the transactions are recorded at original cost. Purchase price and shown in the firm's accounting report at the historical original price. Next is reliability. Information is reliable if it is free from the errors, personal opinions and estimates. It is based on the data that will be checked or verified. It is based on the data that will checked or verified as a source document to verify it. Next is money measurement concept. It is a concept in which all the transactions are recorded in terms of the monetary nature and as some money value relations. This concept assumes that all the business transactions must be in terms of the money, in terms of the currency of the concerned country. In our country, such transactions are in terms of rupees. Thus, as per the money measurement concept, a transaction which can be expressed in terms of money are recorded in the books of account. For example, sales of goods worth 1 lakh, purchase of raw material 50,000, rent paid 20,000, etc. expressed in the terms of money, in terms of monetary nature. So they are recorded in the books of account. But if the transaction which cannot be expressed in the monetary term are not recorded in books of account. For example, sincerity, loyalty, honesty of employee are not recorded in books of account because it has not any monetary nature, money natures of transaction, because these cannot be measured in terms of money. Also, they do affect the profit, the losses of the business concern. Next is the difference between, under the money management concept, the difference between transaction and event. The first basic meaning. Transactions are those business undertakings that have a direct or indirect impact on the finance of the company. Next is event. An event alludes the occurrence of a contingency to a business organization due to the transaction that can be expressed in the monetary terms. What it is, transaction is a cause, event is a effect. Accounting record. Next page is accounting record. Transactions are recorded as they arise. Only those events are recorded which are in the financial in nature. Change in financial states result in change of the financial position of the company. Results are may or may not result in the change in the financial position of the company. The transaction scope is narrow, where the event scope is wider or broader. That's all today's class. If you have any doubt, any query, you can comment in the comment section. I will surely make video. Thank you so much for listening carefully.